Good afternoon. Uh, we will begin the lecture number 12. I believe that's 12. It's about the financial costing and budgeting. My name is Owan. I will responsible for this part, and we will meet twice for this lecture and perhaps the next lecture as well. Uh, both lecture we will use single handout is the one that you see. You can access, you can get this lecture from the course field. We will also start at 1 a.m. sharp. I probably require, let's say, that two quick breaks so that I can recuperate my voice. Otherwise, we can continue. If you have any question, feel free to stop me and ask. So without further ado, let's go to the overview of the topic that we will have. We will have a 6 topic here. First of all, the first topic that I need to address is that you know that finance is basically studied in the business school, but as an engineering, as a second year engineering, why do you need to know finance? What aspect of finance that you need to know? And what are the, let's say that basic finance literacy that every graduate student should know? This is what the topic about. So we will highlight on why we need to concern about finance and costing. Second, we will talk about financial statement. Financial statement is basically the report that company need to produce for the government, for the shareholder, for taxing purpose. There's a lot of information that you need to understand, you need to read, and so that in the future you can know what's going on. So that's a major part of this lecture. And next we will move to what we call managerial accounting. This is the application of finance and accounting that we use the information available in the company for make future prediction, for control, and for as an engineer, this is the framework when you want to calculate the return of investment. If you want to compute NIR, this is the information from the company that we use it for that purpose. We'll talk the broad scope of this topic. Next, we will, after classify the costing in the company, we will discuss about how much we should produce. We will discuss about cost, volume, and profit, or sometimes I call it break-even point. This is how much you need to produce. I will show you that the analysis is related to the financial statement, basically income statement as well. So you can estimate how much you have to produce so that your company is in black. And then we will talk about control to the budgeting. We will talk about budgeting process, and we will talk about variance. I expect that we can cover first 3 topics or 3.5 topics in this lecture, and hopefully we can finish everything in the next one. Okay, so first question, first slide is, as engineer, what you have to know about costing, what you have to know about finance. You can argue that everyone needs to know about finance. Finance is basically how you access to the money, how you get the money. But for the business person, finance is a language. Finance is how we communicate for in terms of with the shareholder, how much, what is the current state of company, what are the issues that you should aware, and sometimes this is the official report. And as a business, first of all, you probably know that business survive by profit. The bottom line of every company is the profit, unless of course you are the government or you are non-profit company. But in general, everyone needs profit to sustain, to grow, and to make shareholder happy. As a profit is have 2 parts. you could see that there's a revenue part, how much money did you make, and how much cost that you have to spend. As an engineer, we are focusing on costing. We are, as the designer, as the producers, as the controller, we have responsible for the cost of the company. That's a more main goal than the main purpose, and and how you control it is actually affect the profit of the company. Revenue side, rarely engineer doing anything about revenue. You can think about if you have very innovative product, you may be have able to control revenue, or let's say that you have a very sophisticated scheme like in airline industry in the past, you can do some revenue management. But essentially what engineer doing is about costing. If you dig deeper in terms of what is the revenue, what is the cost, you will see that the revenue is basically is the price time quantity of product that you sell. This is a general statement. Depending on how many products that you have, how many quantity that you have to sell, this is basically revenues. If you are a retailer, you may maybe the convenience store like 7-Eleven, you may have 3,000 items. Each item have its own price, how many quantity that you have sold. That's revenue for the retailers. But if you are let's say that you in the future you are work in the consulting firms, the price can be the project itself. Let's say that you work with SAP and help to implement some module of SAP. This is the price of project. Quantity of project that you have to sell may be a unique for each firm, but that's a total of project that you have. That's a total revenue. And in terms of cost, for the convenience store, they maybe have the cost to acquire the item, maybe from Frito-Lay, maybe from Singha, or maybe from other company. That is the cost of product. And depending on how many items that you produce, that's also a cost. That's a total cost as well. The 7-Eleven also maybe have a fixed cost, for example, rent, utilities, workers. This is, of course, some fixed costs that company have to incur in order to operate. Maybe as a factory, you maybe have the salary of the manager, salary of the supervisor, or maybe other things that you need to pay, including the depreciation of the machine itself. For the for the consulting company, this cost could be building, could be your computer, could be an engineer that they have to hire to prepare for the project, could be the license of the SAP itself. This is the cost that you have to incur. And the reason why engineer, we have to focus on the cost is that, first of all, the revenue side of business is usually managed by salesperson, usually managed by marketing department, usually as an engineer and as a new engineer, you don't have much to say about those revenues. So sometimes it's very difficult to manage because they have to, let's say they do advertisement, they may have to pay executive, they may have to pay other things that you are unable to control, but you require this in order to advertise your product. And furthermore, as an engineer, what main concern that you have is that you usually the quantity that you produce is actually usually greater than quantity that you sold. If you are the retailers, you have to have more in order to sell. So you have to control and manage how much you're able to sell. You need to manage the demand itself. Make sure that you have sufficient items, sufficient units so that you can sell. And in another sense, the price that consumer price as customer purchase from your company. The price you sell is usually we operate in the environment that we call is price taker, meaning that usually the company itself cannot set up the price. The price that you sell the item are results of the market. For example, if you think about you are drinking water, there's a range, of course, unless you are the functional drink, unless you are mineral drink, then the price that you can charge is at most is 15 baht per bottle. This is price taker of the mechanism of the price taker. So you are unable to set the price. What you can do is about cost, especially the fixed cost and variable cost. This is something that you can do internally. This is something that you can control. As a result, we engineer focus on this cost. If we can reduce this cost, company can achieve higher profit. You of course will get the perhaps higher bonus as well. And this is the overall why we as engineer we need to focus on cost, and why an engineer need to know about costing, how the thing is cost. When we talk about costing, we talk about finance. In your mind you probably think about let's say that some people who in the business, in the BBA, in the MBA. So actually the accounting is language in terms of business. Accounting is the information of how the business operates, and with it written in the way that everyone that know how to read can grab some aspect of what company going on. That's something that I assume that you know. You probably don't know that in accounting there are two interrelated principles. First principle, we call it financial accounting. Another principle, we call it managerial accounting. This class, I will focus on managerial accounting. This is basically how these two accounting principles relate. These two accounting, the source of information come from the same source. You can see from my slide that is in the company, of course, they have program. Every record, every transaction is entered in the program. In July, of course, we also use SAP as an engine that calculate all these costs, maybe including my salary, including some computers, the depreciation of the machine, lab equipment, and to the utility. This is all information that available in the enterprise software. And those principles, financial accounting and managerial accounting, we use this source of information, but we process this information differently. In financial accounting, we process this information and create what we call financial statement. This is the report. These are past report of how company operate. If you are familiar with capital market, you will notice that every listed companies need to report what's going on with their accounting. They need to submit the balance sheet, income statement, and cash flow statement, and this report need to be signed, need to be audited by auditing company that make sure that everything that they report is makes sense, so that investors know that everything is all right. So you can think about the financial accounting as a report of the past. How much money you have, how much asset that you have, and have a standard. It is have regulation about it, and those people those of your friends in the business school is focused on financial accounting. This is what they typically focus on, is how the company operates. In our case, we focus on managerial accounting. In managerial accounting is basically there's no regulation. It's an internal operation. Company may or may not do this. Usually I found that the medium and large size company will apply managerial accounting. This principle of accounting is we use information from the computer, from the record, from the transaction. We try to process and ask future question. For example, what is the ratio of labor per product? What is the cost of the product? You may seem that strange that the company don't know the cost of their product. And I would say that in general, yes, they don't know. They can guess because the company not produce only the single products. They produce multiple products, and how to allocate some of those costs to the product is kind of tricky to do. So of course, if you ask me, sometimes company don't know what is the individual cost of each item. They know only like what is the, let's say the bottom line, what is the total profit look like, but they don't know the cost of each product. Managerial accounting also include how much you have to produce so that you can cover all fixed costs. How to, let's say that, create the budget, how to control the budget, how to control some activities. You can see that in the financial accounting is something that the business do so that they can look in the past performance of the company. But managerial accounting, we look into the futures, what the company going on. And in this class, we of course address these two items. And I will show you how those transactions can create the financial statement. But we will focus on managerial accounting, how we use this costing information for control and planning. Okay. Another way to look at these two principles of accounting is look at comparison. You can see that this is, let's say that the comparison between the financial accounting and managerial accounting. In the financial accounting, we will do for the communication. It's mandatory. We do it for outsider. And another important thing is it have regulation. It has auditing, and of course, every country in the world require regulation. That's a guideline of how we do things, and this is the company have to follow this. Otherwise, they will be get sued or be delisted from the company, from the stock market exchange. So financial accounting is required for the companies. Even though they are not listed, they are requested to submit financial accounting to the internal business affair once a year. For managerial accounting, we use this is for decision making. It's optional. Mainly, you can do or you cannot do. That's fine. It's internal. So there's a person in the company we use this. There's no clear regulation of how we do things. There's of course certain guideline of this is how you should do, and there's no external review. And the reason that we do this is for control and for planning. And this is two different sides of the accounting and the information that you will see in my lectures. I should note that usually financial accounting and managerial accounting by itself is one class in BBA or in MBA. This is one class, but we cramp down everything together. I will provide only the concept. We will not dig down into like the example of the company, how their financial is look like. Can you detect something strange from this financial statement. We cannot do that, but at least I will show example of how we create financial statements, and hopefully you should be able to read it. You should be able to classify and think about why we need to classify it in certain ways. So, and that's the first part. We cover of why, as engineer, why you need to know a little bit about finance, especially in terms of managerial accounting. In the next topic, what I'm going to do is I will outline the key principle of finance. You will see that when you read the financial statement, the good practitioner should apply this following way, so that make sure that it follows certain standard. This standard include, first of all, everything that appear in financial statement is money. So everything will convert into money. We not consider in terms of quantity, whether it's in the pallet, in any unit. Everything will be convert in the money and convert conservatively, meaning that if you should create in mind that this is, let's say, that the minimum. Example of that is that in the July, you know that as a organization, we need to do financial report as well. We need to report the finance as well. And one of the items in July is, of course, the asset. How much July own. What you should probably think is, July probably list term of land. Of course, we list land, but the valuation of the land that you see in July is listed at 0, meaning that the valuation of land, of course, they may have value, they have market value, but July by itself not considered to sell this land. Therefore, of course, we list as an asset, but the valuation is 0. This is conservative. Similarly, you can, of course, company can purchase Bitcoin and list it as asset. And for the Bitcoin, regulation is differently. So if the value of Bitcoin is exceed what you purchase, you can list is only what you purchase, meaning this is the cost, this is the value of the Bitcoin. But if the Bitcoin, the market price of Bitcoin is below what you purchase, since the market is very fluctuate, based on GAAP, you have to list the Bitcoin as market price. So regulation could be different, but the intention of regulation is you should list the asset conservatively. You should not over exaggerate the price of your asset, so that you not mislead any public who read the statement. That's the first concept. The second concept is what we call dual aspect. This concept is actually come from the Middle Age. When we have a trading city of Venice, we will use this aspect in that time. Sometimes we call this T accounting. What it means is that every transaction always have two aspects. One as a gain and one as lose. For example, if you get the money from the company, of course you get as a cash, but your money have to be come from somewhere. It may be come from inventory. It may be come from some sort, and every transaction always have two aspects. So there's a pro and con. This aspect or this principle will help you to, let's say, that make sure that everything is correct, and make sure that you follow the second equation, which is asset must equal to equity plus liability. We will talk about this term later on. And the last guideline is that everything that your company do, especially not something that is common, has to be listed. has to give full disclosure to tell the reader, to tell auditor what's going on. It has to be fair. And if you look at the annual report of the company, you sometimes will see a lot of footnote. This is what's going on, how they calculate. Uh, for example, if you want to change how calculating, you have to listen and you have to see impact. And some company, for example, they may have the special profit by selling some branch of the company, doing something that is not regularly. They have to disclose. This is another terminology that we want, that this is the concept of how things should be. And next, we will talk about this equation. This is perhaps the most important equation in this topic. And you probably heard someone already mentioned that this is the key in terms of finance. Everything that asset is everything that you own. Example, cash, inventory, IOU is a statement that you have owned some money, land, machine, building, intellectual properties, trademark. Everything that you own can be classified as asset. It's something that company own. Asset come from two sorts. First come from equity, something that you already have, something that is the right of the stakeholder. For example, maybe a share, maybe a profit and loss in the company that itself, maybe a common share. This is something equity, something that the owner of the company have invest, or the shareholder of shareholder of the company have the stake in that. This is something that can claim. And liability is something that you borrow. You may borrow from banks, loan, bond, credit card, or you can borrow from your suppliers. This is something that you borrow. In general, if you want to liquidate, you have to, let's say that, sell all assets and give and clear all liability first, and anything left is for equity, for shareholders. And this is the common concept in terms of business. Is remember that in the business, everything that you have, you don't have to own it. You don't have to have stake. You can borrow from someone else and use it as what we call leverage. You can invest your own money less than what you appear. Example of that is let's say that recently there's companies that issue a bond for everyone to purchase, then can raise some money so that they can access to capital. This is example of how the company borrow money from publics. They can do other things that they get liabilities. And if you follow the AR report, you will see that many companies maybe borrow around like 30 or 40% of what their asset would be. So this three word, asset, equity, and liability, is a key so for us to understand the financial accounting. In the next slide, we will, let's say that, use the principle, use this concept, and set up some example. The purpose of this example is to illustrate that based on your business transaction, it can create a financial report, financial statement. And another purpose of this example is actually, you can see that there's something going on step by step in terms of each financial accounting, how each financial statement create, what are they represent, and what is, let's say that, what is how do we classify. What you see in this slide is actually the example. I actually copy from one book. I cannot remember which book, but it's probably the most basic example. Basically, Mr. Smith, after he graduated, he decided that he will create a company. This company is doing a car washing machine, cleaning the car using some equipment. So the company will be located in Atlanta, and he decided there's a two group of customers. Two groups. First group is retailer. That's person who passed his shop and decided his shop is look good, advertisement is look good, so they get a car wash. This is retail customer. This group of customer always pay cash. And that's another group. And this is the main reason why Mr. Smith decided to, let's say, set up the car washing machine is he have connection with corporate. You can say that it can be Coca-Cola, can be DHL, it own fleet. He decided he will wash all this corporate car. And since this is a big account, they have 2 months of credit. What is mean by 2 months of credit? Meaning that they bring the car to wash. Mr. Smith wash it, or Mr. Smith employee wash it, but he will receive the money 2 months afterward. For example, if he sent there's a car in the January doing the washing, he will get the money in March, not in January. So that's a delay of the money. And this is very important. As a new engineer, as a student, you're probably not familiar with a credit. You may be familiar with credit card, but in the business, we can have credit. If you are, let's say that you have a business and you have established relationship with your customer, sometimes when you purchase things, you can delay the payment. And usually what is 1 month, meaning that you get the item in February 1st, and then you have to wait and pay cash afterward. And this is very common practice in the business. And some company, for example, Siam Macro, you probably know this, they do business like Costco in US. Basically, there's a wholesale retailer, meaning that they purchase. You can be a membership of this company and purchase a lot of things, and you will get, let's say, special discount. And one thing that they typically do is you have to pay for membership, and they use the money that you pay at the purchase of your trip, your grocery, and use this as since they have a lot of good credit, say they can use this money to pay their supplier. So basically, they get the money first and then pay supplier later on, even they purchase it first. This is how they do business, and this is how they grow. So go back to the example. They have two type of customer: retailers and corporate. Retailer, Mr. Smith get the cash. Retailer, for the corporate, they have to wait for 2 months before getting the money back. And he invests $50,000 of his own money for this company for initial investment. And this is the transaction that happened for the first 3 months of this company. Let me group this. This is for simplification. This is the first month. This is the second month. And this is last is the third month. You can see this transaction. We have to convert this transaction into a financial statement. And the first transaction of business is you need location. So Mr. Smith purchased the land that he gonna build this company, set up the car washing machine workshop, $40,000. This is the first thing that you will see. Second, he need business supply. He need to, let's say that, purchase thing from the suppliers, but he do it by credit. Something happen is you purchase thing, of course, but you not pay immediately. You give it IOU. You give some credit for the supplier. They will get money later, but you have to do business first. And next, you will have three types of transaction that happen quite a lot in this example. First, there's a rental earning. You earn in cash. You have some corporate earnings as well. And you have to pay for the people, pay for the equipment, pay for utility that you have. This is the monthly of operation expense. These three transactions, if you look at across all the example, you will see similar transaction appear all the times. Oops, sorry, this one is incorrect. This typical three transaction is here. Expense. And of course, every month you will get money from retailer, from corporate, and you have to pay for operation expense. This is three transactions that happen all the time. Think about this is common transaction that happen for every month. You receive money from two types of customer. You have to pay for your employees. This is typical three things that happen. In some months, there may be a special transaction. For example, in the February, you decide to partially pay the supplier. Or in the March, you maybe say that the 40,000 land, plot of land is too much. You need only half of that. So you sell it for another half. This is how much you get for the money. You maybe remodel your home. Since you get the money from the selling land, you maybe decide that this is time to remodel your home. Or you may be, another special transaction is this one. You finally get the money. This is from January, of course, from the corporate one. And this is what, and you maybe decided to have dividend. Question that you may have in your mind is that if you have seen financial statement in the past, it doesn't look like this. This is what we typically call is as a transaction, or some people may call it ledger, because of we, rather than we say specific transaction, we begin to group. You can see that, of course, for the retail, for the individual customer, they may come, maybe the first day is only one car, second day two car, but we group it together in the whole transaction of the month. This is sometimes we call it ledger, but that's technical term. But you can think about this as transaction. How company transfer all this transaction and create financial accounting. This is the question that we're gonna explore together. And of course, I will do it step by step. This is how the company do. We will do month by month, and especially during the January, we will do it in detail by transaction. So this is, after you understand all the transaction, this is what's going on. At the beginning, this is the beginning of January. Of course, what's going on, the first transaction is money. So Mr. Smith give a cash to the company. He have a cash, which is the company have asset. And of course, remember, do all aspect, right? So there's equity, there's a claim, there's a stakeholder of Mr. Smith to this company, 50,000. Notice that these two transactions, the value is matched. And if you look at the left-hand side and right-hand side of this term, away equal. This is away the concept behind this. And if you go back and look at the first transaction, you will say that they have to purchase land. Question, that probably your accountant have to ask is how much you pay for the land. Of course, they pay using cash. And this is what's going on. You can see that rather than we have cash 5,000, there's some subtraction. We use 40,000 to purchase land. So the cash, there's a reduction of cash 40,000. And that's a new item called land. 40,000. This is what happened. This is also dual aspect. You reduce cash, but you gain something with me. So this is the first transaction. Next transaction, he used his connection to purchase the business supply, but he didn't pay yet. He used a credit. This is what's going on. If you purchase things using credit, your suppliers become your reliability. This is basically your borrow item, you borrow supply for business supply from your suppliers, and you have to list it as account payable. This is a future that you have to pay, but you're not paid yet. And you also have business supply. This is, you can see that these two transactions, these two items linked together as single transaction. Basically, the act of purchasing business supply will create reliability if you use credit. But if you use cash, there will be reduction in terms of cash. This is what's going on. So this is our dual aspect. And in terms of business, you have to very careful of how you purchase, how you get paid. Are you paying by cash or are you paying by credit? If company paying by credit, you have to be list differently. We not treat things the same. The reason is that in terms of credit is something that is not happened yet. It's not cash. So in the future, let's say that if thing is not going well, you may decide that you're gonna pay your supplier less than what you owe. This is also possible, and it happened time to time as well. But rarely happened. Usually, we want to keep a good business with our supplier. We need to pay it full price. We have to pay it at a green price. But if business is not good, of course, we can cut throat. We can ask for more discount. This is what's going on. And last transaction, we have some business. You can see that we have received cash from retailers, customer, and we also receive another cash from another credit from corporate. This is 2,500 and 1,000, and this refer to this item. Let me make sure that this is two items. And the last one of February is, of course, we have to pay expense. This is 1,100 that we have to pay expense. And notice that everything have to be left-hand side equal to right-hand side. And we now have something we call cumulative profit. This is a profit that company have. This profit, of course, we take in terms of the corporate, the revenue from the corporate, the revenue from the retailer, and subtract with expense, and this is become our cumulative profit. Notice that cumulative profit is sometimes a future profit as well. Some part you receive in the cash, but some part is a credit. This is if everything go well, everything go according to plan, this should be convert. This cumulative profit should be convert, become a cash. You can access it later on. Okay, any question about the first month? I noticed that I go it very fast. Usually I'm a lot slower than this, but make sure that you follow the first month. If you not follow the first month, you will have a question in the February and March. Everything good, right? I assume that everything good. Okay, if If we are the one who issue the credit, meaning that let's say that in this example, you see that corporate customer, right? We have customer, we issue the credit, we provide the service, we wash the car first, but they not pay the money. This is what happened is we have extra asset. This is account receivable. This is the future that we expect to receive from customer. This is a customer, and this is here, account receivable. You should be able to receive in the future. And if the time comes, the account receivable will convert into cash. Does that answer your question? Let me write it down so maybe it's clear. This is credit to customer, and conclusion it will get cash. This conclusion is will pay by cash. Okay, is that clear? So account receivable is something that customer is become you become creditor. You give the credit to customer. Account payable is something that you need to pay, but you're not paid yet. Supplier give you credit. You need to pay. You need to pay, but in the futures. Is it clear? So, and actually that's a good question, because the example that I try to set up here is I try to break your paradigm in terms of you as a business owner, as an engineer, you have to aware that sometimes you can get the product without pay yet if you are the company. Any questions about the first month? Okay, good. Okay, for the February, we also follow the same transaction, so I will do it quick. So this is what happened at the end of February. One thing that you probably see, this is very important transaction, is this one. This is your partially pay. You partially pay suppliers. Once you pay, what happened is how much money that your own supplier reduce. This is what you pay, and this is also happen because the money have to come out from your cash to pay it. So this is why we have dual aspect. Things change. Notice that cumulative profit also increase. Account receivable also increased because this is from January. This is from January. This is from February. We not get the money yet, but it's increasing. Now, February should be fine. February is the month that I use to make sure that everyone is on the same page. With of course, the new transaction, that what happened if you partially pay what you own. Of course, your liability will reduce, but your cash also reduce as well. Last month, which is March, this is a lot of transaction. Let me break down, because usually this will lead to the let's say that confusion, especially this one. This will lead your confusion. Let me recap all the transaction that will happen in March. you decide that the land is too much. You want to sell half of it. And since you purchase the whole plot of land is 40,000, you sell it half for 22,000. You make 2,000 of profit. This is 2,000 of profit. That's a new transaction. That's a Mr. Smith want to remodel his home. And this is the highlight of this example. Another thing is you begin to receive the money, the cash from the corporate. What's going to happen? And you set up for dividend. You say that the business is good. You will get some money from the business and use it for something else. And this is what's going on in, let's say that this is at the end of February. First thing first, if you let me zoom. First thing is that you sell land. You receive the cash as the land seller, 22,000. And since you sell your asset, of course, you have to reduce the asset itself. And the asset is the full plot of land is 40,000. You sell half of it is 20,000. So what I want to say is that this is something that rings together. Meaning that because of your selling land, your asset, your land is reduced by half. This is what common, you know that. But when you get the cash, you get more than half because the half is only 20,000. The money that you get the cash from the land is 22,000. What remaining 2,000 where it go to? It go to the profit. It go to equity. So this is one thing that happen is if you sell your asset and the value itself is higher than the listed value, so it go to equity. If the value that you sell is, of course, it's possible that you sell the machine and the listed value is actually higher than what you sell. Of course, you take a loss as well. And this is what's gonna affect if you sell your asset. Next, you will see that the typical thing happen is you get the money from retailer. You get also you get and money from the things in, let's say that, let me write this down. This is from March and this is from January. So in terms of credit, you get a new credit from March. You get money from January, and this money is actually lead to this one. So you get a cash from corporate. Therefore that's a reduction for the account receivable because they paid, and you get the cash. Notice that profit doesn't change. You already assume that you make the profit. Make the profit. And of course, another thing also happen is that you begin to have dividend. This is dividend, and dividend is will pay by cash. And to be fair, you may list this as a dividend as well. And of course, the total cash will be reduced. So dividend is gonna be, you may be account dividendable. You prepare the cash for pay dividend. The action of pay will happen in April. You will notice that all these transaction, all this information, if you compare to transaction, you will not find a remodel of his house. Question is why? Notice that no remodel. The reason is that, remember, this is the financial statement of a balance sheet of his company, not his own. Meaning that we don't know what is the sort of Mr. Smith, how he remodeled. But of course, it's separate entity between Mr. Smith and his company. So basically, what he do with his house is not related to this company. So the legal entity of the accounting is very important. And I would say this because in Thailand, to be honest with you, some executive, maybe they can get the benefit from the company. For example, corporate car. For example, if you have to, let's say that treat customer, you also have budget for that as well. In that case, corporate also pay for you as well. But in general, what you do is separate from your corporate. Do not mix. So therefore, if we look at the financial statement of the company, you will not find this because of wrong scope. So the transaction that I list is so that you understand that that's a code of what you should list in the financial report. Something is sometimes is not related. If, of course, if Mr. Smith said that if this 30,000 of his remodel home have to come from the company, this means that he will have to reduce his share. It's possible that he will say that he wants to reduce the share from 50,000 to only 2,000 and get the cash 30,000 to pay for this remodel, but there's no specific information about this. Therefore, we assume that he not get the money from this company. He maybe have his own money, his own stat. That's something else that not related to our accounting business. So, and this is gonna be what happened in the beginning of April. Notice that there's a money deduction in terms of cash because of dividend. Okay. Everyone have the same page, right? Everything okay with this, how we do accounting, how the, let's say that accountant or programming use the transaction that we have and create this information. And this information is something that you have to submit to the government. Okay. I assume that everything okay. So far, what you see, this information that you see, we call it balance sheet. Balance sheet. And there's another two report that you should know that is hidden from what we're doing. The first one is profit and loss, which is in the green here. This is concerned with the profit that you have. Another thing is cash flow, is how cash change over time. What you will see, this is the three financial report for three financial statement that government need for you. And all these three reports are related. First of all, what we're doing so far, what we call it balance sheet, is a snapshot of how asset look like. It will list what is this asset come from, is that you borrow or you have claim for this asset, and what form, what credit, what quality in terms of money that you have so far. We look at balance sheet as the snapshot. Usually balance sheet by itself is useless. How we analyze the balance sheet, you have to have more than one period, or we have 2 or 3 periods, and you see how things change over time. What item increase in value, what item decrease in value, and ask what's going on. That is how we use balance sheet. It's a snapshot of how much company or how much company worth it. Second part is profit and loss. This is in the green on your right hand side, this is tell you how much company make profit or make a loss. And what in green here is what company think that they will have in the future if everything go okay with the plan. Notice that some of item in profit and loss is credit, meaning that you not received a cash yet. Meaning this is something that may be some issue that you have to concern. And this is reflect on cumulative profit or cumulative loss. They may reflect on dividend as well. This is the company, how much performance company doing over times. And last is cash flow. Cash flow is how much cash is changed over time. This is, of course, related to the real money that you pay, money in terms of cash. This is how much cash. Usually, companies say that cash is king. Cash is something that company need to look after, make sure that they have some liquidity required to manage, to survive, to thrive in the business environment. So this is tell you the statement, the lifeline of the company, how much the health of company look like. This is a vital sign in some sense. If the cash flow is not look good, it will affect profit and loss, and of course it affect asset of the whole company as well. So this is a statement that you have to look at it. So with the example, I begin to introduce what is the three financial statement look like. And as an engineer, of course, you don't have to be able to do this financial statement, but at least you have to be able to read what is the meaning, what are the information that you can use to evaluate the company, evaluate the project. This is something that you have to know, and this will be discussed in the next part. I will we will have a short break, 10 minutes, and if you have any question, feel free to ask at the meantime. I will resume at 2:15. Okay, no question. Good. Okay, well, we will resume at 2:15. I'm just curious, how much of you have background in basic finance? If you have some knowledge in basic finance, please raise your hand. 1, okay, 2, 3, 4, should be 5. I mean, this is something that you can look at from the internet, but I make sure that I speak it out loud, say it out loud, so that everyone have the same page. Okay, see you at 2:15. Okay, welcome back. Uh, Before break, we look into example of car washing machine, car washing companies. We see that from the transaction that Mr. Smith, as the founder of the company, have, how he can convert into balance sheet, how it affects. The main message is that for each transaction, you need to understand that cash and credit, we treat it differently. And each transaction could affect, have dual aspect. It can affect maybe asset only twice, or asset and liability, or asset and equity, depending on things would have. Even though we do what we call balance sheet, we also have another two report as a cash flow and profit and loss. This is also another two report that highlight on cash and the revenue of the company respectively. The second half of this lecture, we will discuss about these three reports, what you should look at it and what you should aware. So the summary of this three report, you can see it here in this slide. So what we focus so far, what we call it balance sheet, is list the asset, equity, and liability. This information or this statement, you will see that is a way we call it balance sheet because two sides must equal. It tells you the snapshot of what's going on in the company. When you look at the balance sheet, please notice when it creates. When it creates, it's very important. Usually balance sheet, typically for although the company may be different, the format is kind of similar. So be careful that you can, if you want to use it, make sure that although it look the same, but you need to compare it with the same type of the company. Do not use this form to compare across. It follows a certain format, but be careful. For the profit and loss, or usually I call it P&L, and cash flow, this is have duration, meaning that this report, if you look at this report, it will state that this is the information from at the beginning to which end. You in this two report, you will see what is the initial, what is initial cash look like, what's the initial cumulative profit look like, and will update into the final. So it tell you duration of what's going on. For profit and loss, it tell you usually company report profit and loss only their core business, meaning that if they are retailer, they will report only like what is how much money that you get from receive and selling item. If there are special revenue, for example, selling the land or doing something that is not in their core business, it will not appear in profit and loss. It may be listed as the special profit or special revenue. Another thing that very important about profit and loss is also begin to list depreciation. So as an engineer, you should know that what the machine that you purchase, when of course you have to pay it by cash or maybe short-term credit. But when the value of machine appear in maybe in your balance sheet or in anything, it will usually appear in the form of depreciation. We will talk about it detail later on. Think about cars. You're probably familiar with cars. Of course, when you pay a car, you can use it for 5 or 10 years. And if the corporate car is it a corporate car, it consider the car as an asset as well, and it will depreciate, or the value of asset of the car will be gradually reduced over time. This is for tax purpose and for to take, let's say that to consider this is part of investment, part of what you have to use. Think about that you have a van or the truck that you have to deliver items to use. part of it in the operation, and so you can charge the money. Profit and loss tell you what very important key information is margin, how much money you make from your main business, main operation. And of course, it will list another thing as well. We will look at it later on. And last is cash, how much you spend, how much actually you spend or you receive over time. This is including tax, and it provide what is the liquidate, how much the health of the company look like. In the next slide, I will dig into each report and tell you what you should expect each report. And you will see I begin to classify things, and the common theme of this class and in general common theme of engineering, you will see that we classify things. Please remember that there are many ways to classify items, but what is the purpose of this classification? So without further ado, in the next slide, we will talk about balance sheet. Balance sheet is a snapshot. It tells you what's going on with the company, what are the assets, and where is the source of money. Is that your own money or someone else? Usually, as I mentioned earlier, balance sheet by itself, if you have only single period, is useless. Balance sheet will become more useful if you have multiple periods, if you be able to compare between different periods. And in terms of balance sheet, we typically define things as current and non-current. The term current is means something that can be usually convert or liquidate. The formal term is liquidate in terms of money with easily in 1 year. Non-current is something that is difficult to liquidate in 1 year. I mean, when we talk about liquidate, we mean that you have to sell at almost get the full price of that. The example of that I usually provide you with a car. Usually, if you say that you purchase Toyota Camry for 1.4 million baht, it's new one. If you want to sell it, let's say that for 200,000, people will willing to buy it. But if you want to resell it at full price, it becomes difficult to get the full price. It may take times. So usually in terms of finance, we separate in terms of money, in terms of how much time that you need to get the full value or almost the value of this item. Similar with for the non-current, similar with your apartment, land, machine. Sometimes it's even include like license fee. Sometimes including the intellectual property also considered to be non-current. For the current is something that is easily to convert. Cash is number one. Is already the cash is money itself, so it's no problem. Your bank account also considered to be current. Your inventory typically is current as well, because you should be easy to sell your money. Listed corporate share, if it lists in the stock market, is also fine to look at the current. Some people look at the government bond if it's less than 1 year as current as well. And the reason that we separate between current and non-current is we think about, in terms of this balance sheet, we think about how much can you, let's say that company is, can you cover liability in the short term? Of course, when you borrow money, you have long term and short term. If company fail to pay what they own, that's going to be bankrupt. So therefore, when we separate asset into current and non-current, we usually look into how much the ability of company to pay the obligation in terms of liability. And we also look in terms of money. What is the ratio? Is that money is used a lot in terms of capital? Is if it in the machine, if it in the building, this is maybe a good for a certain business, not so good in some other business. For example, if you are factory, Usually, factory have a lot of non-current, but if you look at the service industry, they usually have only few non-current. The value of non-current should be low. Non-current can be further separate into, let's say that we usually separate in further into tangible and intangible. Literally mean tangible, it means something that you can touch. If it land, if building is touchable, so it's tangible. Sometimes non-current can be intangible. For example, it can be some kind of license, can be goodwill. Your reputation can be listed as asset. Uh, can be trademarks. Some company list trademarks as their non-tangible asset. So this is how things can be listed in the asset. If you look at all this intangible, if the company have a lot of intangible, you should begin to ask yourself, is that the value of this company is okay? Some company, let's say that Google, you will see that there's a lot of asset in Google as intangible. They have a lot of license, a lot of, let's say, the patent that they own. So this is maybe we are not going to the valuation. So I'm not sure about the value, but is some warning that if it have a lot of intangible, you maybe have to ask about valuation of the companies. Some company also look at what we call fixed asset. Fixed asset is a large, probably the largest category of non-current asset. It's something that usually company keep it, maybe equipment, land, something that usually not change over time. This part is not change over time. So this is some awareness that you should aware in terms of assets. For liability, we also separate like asset, separate into current and non-current. And when we look at the current or non-current, we also do, usually when we analyze the balance sheet, we will do the ratio test as well. The certain ratio have to be followed in certain way, certain standard, so that we can compare two different companies, but that's detail in the finance. What you should aware is that what is this term mean? And lastly is equity. Equity is usually in only two part, is the share capital share of the company. Notice that the share of the company that lists in balance sheet is different from the price that you trade in the stock market. For example, if you look at the share price of Siam Cement Group, SCG, you will see that the share is listed as 1 baht. This is not trading price. This is the book value, or meaning that this is the value variation that initially have happened. Or if you look at detail, you can see that there's a lot of cumulative earning that happen in the company. That's the value of the company. And the company is bankrupt if the asset, the most major of asset is come from liability, meaning that if the obligation that company need to pay out or liability is equal to asset, then the company is bankrupt. There's no value left for the shareholder, and the company will go to bankruptcy process. Doesn't mean that company don't have any asset, doesn't mean that company don't have money, but what they own is actually have to pay for liability. And the process that we can deal with bankruptcy is usually the banks or those who give you credit will convert themselves in terms of shareholders. This is something that usually happen for bankrupt company, but aware these two parts. And if liability let's say that greatly exceed equity and equal to asset, then your company is bankrupt. And that's information about balance sheet that you should know is snapshot. You need more than one balance sheet in order to analyze. And what you should look at is look how things change over time, especially inventory. Next report is profit and loss. Profit and loss, sometimes we call it income statement, is the statement, financial statement that tell you how much money, how much revenue that you sell, what is the profit of your main operation. Please note that this is your main operation. If it's something is not your main operation, it will be a supplement. Usually for the retailers or for the factory, we begin with the gross revenue. This is how much items that you able to sell for the whole period, usually 1 year. How much money that you can make from the selling items. It have to be begin to subtract with cost of goods sold. This is the cost of the item, the original cost of item that you sold. The quantity that of the cost of goods sold have to equal to quantity of that you sell. So you list only the item that you able to sell. That's the reason that we use what we call cost of goods sold. The result of that is will give you what we call gross profit or initial profit. This is how much that you have to be able to achieve. This is how much profit, or usually it's initial margin that you have. Next, you will begin to subtract by, let's say that sell, general, depreciation, and other things to get into net income. So basically, there's a step into before this is how much you have to pay, how much the company have to earn, and each step have a meaning. Here's a detail of what's going on. What we usually have is we begin with gross revenue. This is how much company make during certain period. And of course, there's a cost of goods sold. Subtract cost of goods sold. The result of that is usually we call is gross profit. Next, in order to sell item, you usually have some kind of admin. You have some marketing, or you have other things is can be sell, general, admin, and marketing. This is the cost that require you to get the item, and this will lead to the first item that you probably confuse. It will be called EBITDA. EBITDA stands for earning before interest, taxation, depreciation, and amortization. You can find the whole notion in my lectures. So this is like the profit before subtracting that you may need to pay. Next step, usually company will begin to pay for DA, depreciation and amortization, and it will left with EBIT, earning before interest and tax. And of course, next step, you will have to pay tax, interest, and tax. And you will get with net income. And then some company, they consider to pay dividend as well. and it will left with net profit. So first, this is how things subtract and how things is called. Usually, we will say that this term uh, EBIT, EBIT, and uh, and operation profit is the same. It's the same. This is sometimes we call it operation profit. So, okay, let me recap everything. So this is for the company that, let's say that retailer, they sell things. First of all, you get revenue from the item that you sell. In order to report this income statement, mainly the how much the money that you have, that you company perform, you first of all, you have to subtract cost of the item that you sell. This is cost of goods sold. You will left with gross profit. Usually gross profit, we look at some company, we look at 30%. Some company we look at 40%, but the less that I usually see is at least 20% because company have to make a lot of money in order to pay for executive, pay for some marketing campaign, pay for other things, pay for equipment. That usually gross profit is quite high. Then you subtract with sell administrative. This is cost of in order to sell the items. In order to sell item, of course, you need some transportation, you need store, you need some advertisement, and we left with EBIT or earning before interest and depreciation. This value very important in terms of finance. Reason is that if this value is negative, meaning that the company, this period company is no good, totally screwed, because without, let's say that the sale that the company have cannot, let's say that cover the cost of everything that they have, not include some obligation in terms of tax, interest, or the machine that they have to use to produce item. Meaning that if EBITDA is negative, company cannot carry yet their own weight. Meaning that is if you left it, it will, let's say that reduce the profit over times, and then it's very bad. During this period, of course, we know that we have problem about COVID. We have problem about tourism. Some analysts may okay with negative EBITDA, but in long terms, this is not good. And we also have to subtract depreciation and amortization. Let me mention this first. We call it depreciation if it's something is tangible, for example, equipment, for example, building. And for intangible, we reduce its value with amortization, maybe the license. You get the license to operate for, let's say, 3 years, and this is cost of license. You already passed 1 year, so the license cost, it become depreciation of the operation that you have to perform. Are you okay with me? So usually you will ask about what is amortization. Amortization is a reduction of intangible asset that company pay it beforehand, like depreciation, but for depreciation is for tangible. After you subtract depreciation, you will get what we call, sometimes we call it operating profit. This is something that company begin to operate. This is the money that we begin to receive. If you don't have, let's say that tax obligation, you don't have interest, this is the money that you will see. But sometimes company need to pay tax. Sometimes, of course, there are interests that they need to pay. And the reason that we highlight EBITDA but not EBIT is because of sometimes tax and interest you can postpone, negotiate. Therefore, it's not very serious depending on situation. For example, last year there's a campaign from the government said that they will get your tax less than usual, or you can negotiate with your banks that you can postpone your tax, your interest. And this is something that's the reason why we typically company highlight on EBITDA. And of course, doesn't mean that you don't have to pay tax or interest, but in some situation, EBITDA is the, let's say that leading indicator of the health in terms of operation of the companies. EBIT is not clear because there's depreciation is also a big thing as well. Sometimes you invest a lot, therefore there's a depreciation as well. Usually we associate EBIT with operating profit because in terms of production, depreciation and amortization is a part of the cost of company as well. Then we subtract with the tax. After subtract with tax and interest, you get net income. This is the money that company may think. Some company may want to divide. Let's say that give it to shareholder and it becomes net profit. And depending on which company, they may report. Usually when they report ROI, they report net income. But some company maybe let's say that postpone dividend and report other things. But this is the whole step. What I want to highlight is that there's a two term that you probably see that sometimes we call EBIT. It's meaning that is operating profit because we take out everything, including depreciation. And the key information of this slide is that money that you receive have certain costs, and one cost that you should aware is depreciation. Depreciation, of course, is the cost of a machine, but you already pay, but you need to take it from the profit. Otherwise, you're gonna, let's say that you operating for free. This is not good. Any question about profit and loss income statement? I need to highlight that income statement is only the main operation that we do this. If it's not the main operating, we're not gonna do this show in detail. Any question? Let's say nope. Okay. Last report. Sorry. Okay. The last report is cash flow. Cash flow is, of course, we do deal with the cash only. So you will see that what is the, we will also divide the object in the cash flow into three types. First of all, operating activity. This is the cash that you receive from the main operation. Is, of course, linked to the income statement, and of course it linked in terms of income statement lists both cash and credit, but from the cash flow it linked only the cash. We also list the investment activity. If you purchase new equipment, if you invest in other companies, this is going to be appear actually going to appear here as well. For example, let's say that you purchase a bond or purchase stock of the other company, the benefit, the dividend will be shown in the investment activity of the company. And lastly, in terms of finance, company, of course, maybe have financial obligation. They may borrow money, maybe from bond, from banks, and they have to pay interest. And the way that we do it is also listed in financial activities. Usually, cash flow statement is kind of straightforward. You look at the source of money and how much you pay. The main concern is that be careful that some company investment is kind of huge uh, compared to operation. For example, if you look at PTT, Potato, investment is kind of huge. So you have to aware that they use how this is the purpose of the money, how they use it, and how it will get returns. And this is all 3 reports that you should know. Each company have to do all these 3 reports and submit to the government, and in order to, of course, pay tax or get tax benefit. For the listed company, they have to submit all these 3 reports after audit every quarter. So this is information that you will have about every companies. And the question that you need to ask it first, do they need 3 reports? What are these 3 reports? What are the information behind inside these 3 reports? So to recap, balance sheet tell you what is the snapshot of the company at each period. Cash flow tell you money, cash on hand of the company during duration, and what is the source of this money, where it's come from, where I have to pay. For the profit and loss, tell you the main operation, what is the cash and credit, how much of the profit that company have for this period, and how much they have to pay for depreciation, for investment, for interest and tax. And all these 3 reports tell you different story of the same company, different aspect of the same company. And of course, usually we need all 3 reports. And for the more complex company that they have changed a lot of stakeholder, you may have another report as well to tell you what is going on with the stakeholder, and that's a special report. And all these 3 reports tell you different story. In the short term, we usually look at profit and loss, so you can see what's going on during this period. And we use the cash flow to check the health of company, what is the cash look like, and balance sheet to see what's going on in other aspects. So use 3 reports, and of course different each analyst have different approach of how to look at the report, depending on the sector that they are in, depending on the industry. Sometimes even depend on the situation of what they want to look at it. And next thing that I should add is in terms of financial report, be careful about practice. And in terms of financial report, remember that there's a regulation. If there's special revenue, special expense, this have to be noted and highlight. And one practice that usually company have problems is how they list inventory. So inventory is very tricky things, not in terms of guideline, but in terms of usually the source of how company cheating, do fraud. So be careful about how company list inventory. Example of that is that some of you may know this company is very old one. Is called AOL, American Online. At this point, of course, this company is bankrupt. It was purchased by Yahoo.com, and Yahoo.com is no good anymore. So we have left only like Yahoo Finance and Yahoo Japan. That's the main business of Yahoo. And for those who don't know Yahoo, Yahoo is the initial investor of Alibaba. So the story is what I'm going to tell you is about AOL. In the long ago, like 15 years ago, if you want to access internet, you need modem to access the internet. So AOL, what their main business is they sell internet package to model. And of course, in order to access internet using modem, you require certain software. And usually this software is provided for free. You can, of course, you cannot at the time you cannot download. Internet speed is very poor. You need CD or DVD. And the practice that AOL get into trouble is that they list the free CD that they provide to customers sent by mail as inventory. This is obviously the breach of regulation. What is the CD? In this case, since it's give for free, you cannot consider this as inventory. This is the marketing campaign, it's marketing items. It may be converted into sale, but it's not inventory. So this is what they get in trouble. And if you study Thai business, there are also another company doing same thing like this as well, but not caught. So that's another story. So be careful about, let's say, that depreciation. Depreciation is also a sort of controversial in the sense that company can choose how they want to depreciate their items. Usually typical company will do linear, constant over time or uniform over time, but there's certain regulation that you can depreciate item in certain ways. So be careful about how they depreciate as well. And you have to, in order to utilize financial statement to the fullness, you have to understand business. Each business, each analysis have specific purpose. So you do not use the same analysis for different industries. So be aware that you should compare apple to apple. Even though the statement maybe look the same, but you have to understand that this may be come from different environment. As engineer, of course, you maybe have to verify something in financial statement. Thing that you should look at is value and validate. Usually the fraud happen for the item that is overvalued. No one gonna undervalue their asset. So you look at the overpriced things. Usually inventory, something that difficult to verify. So far, I did not see any high valuation of cash. So inventory is something that you should aware. Some tangible asset and especially intangible asset should be aware, because sometimes, especially in this you're probably familiar with NTF, right? NFT, sorry, non-refundable token is basically the right of how you use internet digital trademark. Is maybe the right of the, let's say that for the digital art, this is the right of the ownership right. I don't know about the valuation in terms of the right of use yet, but NFT is kind of big thing for this nowadays, and there's some bidding going on and some high valuation in terms of non-refundable token. So if you are into that, please be careful about how you're gonna list it. How much? Remember that it's investment, so it need a good return. And that's valuation of NFT. I have no idea. Usually, you should be aware of non-current asset. This is something that very easy to, let's say that, to cheat, to do a lot of claims. And also inventory is also usually the sort of what we look at when we want to verify things. Another thing that you need to aware is if you sell a lot of item as a credit, this is another red flag. Usually the company may think that they can collect all the credit, but in truth, no. company, maybe 1 or 2% of their sales is uncollectible. You may heard in terms of bank is NFT. So not NFT. It's bad loan. It's called bad loan. I cannot recall the buzzword of that, but it's basically that this is the bad loan that the bank maybe have to, let's say that put aside this money, maybe think about this as a loss. So in the business as well, if you have a long credit, and if the environment, the business environment is bad like this time, you may, if you sell a lot of items as credit, be careful about how you're gonna, let's say that you may be unable to collect that debt as well. So that's a collectibility become issues. Some company even put aside, let's say that 1% of their sales as the uncollectible, and that's you have to manage. And in terms of financial statement, we use this tool as not only like a report of the government, we also use this tool as the investigation tools of what's going on. And it's also very important of you as engineer that you should aware that there's a fraud, tendency to fraud, and it's come from, this is the picture here, we call it the triangle of fraud. So there's three things that you should aware when people going to cheat, to fraud. Basically, first of all, there's an opportunity. There's an opportunity that they be relating to the cash itself, relating to the credit itself. There can be fraud. There's a pressure in terms of maybe monetary, or maybe some pressure in terms of unfairness. And there's also have to be rationality, that they think that they can get away from this one, or they can think that this is a fair taste, a fair reward for them. So this is something that you should aware in terms of when you see this information. I'm not saying that you should assume that everyone will cheat. If you're doing this, you will have a red tape, basically like the government. The mode of their operating, they assume that everyone gonna cheat, so they set a lot of rules so that, and this encourage people to do things so that hopefully they can avoid cheat. But on the other hand, it creates a lot of red tape, inflexibility in the system. So you should aware that too strict is not good, but you have to make sure that it's accountable. And that's information about financial accounting that you as engineer should know. You should know about how we create report. You should know about how we read the report. Of course, the way that we create report, detail of how to list things, you should not, you are fine, because we have program, we have accountant for that, so you don't have to do that. But you should at minimum read the report, understand what each item mean, and how to classify this item. Any question before we move to the next topic, which is managerial accounting? Assume that you don't have accounting. So the highlight of my lecture is actually this second half. Is managerial accounting. Is, of course, we want to use financial information. We want to use accounting information that each company have to create something that useful, create something that helpful for analysis, for decision making. So what we're going to do in the course is we're going to focus on managerial accounting. This is the way that we use past information to make a better decision and control your operation, to make sure that you allocate the, let's say that the cost, the indirect cost to the right items. Make sure that you have, let's say that know how much you need to produce. Make sure that you know how to set up budgeting and use it as a control mechanism for the operation. And in this principle, managerial accounting, there's no regulation. There's a concept, of course, and but within the concept, you can do whatever you like, depending on your effort, depending on what you want to, how accurate you want to estimate. So the key concept that I need to highlight is in this class is first, we need type of cost. We need to classify, and you will see that there's a many way to classify the cost that happen in the factory or happen in the companies, depending on the purpose. With different purpose, of course, there's a different terms that we want to use. After we classify the cost, then we want to manage it. Some people want to manage it by unit price. So you want to compare, you want to trace how much, what is the standard cost would be. Is it that gonna be, if it exceeds standard cost, you want to, let's say that, look at what is the sort of variance. You want sometime after you get standard cost, you want to set up a budget. This is how much company allowed to spend. Sometimes, of course, you want to calculate how much you want to produce. This is what we call break-even point. And during the operation, of course, there will be certain costs that it's not obvious that what this cost it belong to which item. For example, the salary of driver, or the salary of, let's say, the executive, or some stationery that you use in the companies, or some kind of box, or some certain rent. What we want to, of course, allocate these costs. And when we allocate, we also want to control. That's another practice that very important, very powerful in terms of measuring costing, but we cannot go into detail. It's called ABC, or activity-based costing. This is a way that we use activity that relating to the cost to control itself. The example of ABC that you're probably familiar is when you go to hospital. If you look at the receipt or the bill that you get, you will see a lot of items that you never realize that this is how the hospital charge for your visit. For example, nurse, some medical equipment, some kind of doctor fee, some kind of another fees relating to another things that maybe you just want to visit just doctor and go back. And then there's a lot of things that happen that do not realize that this is they charge you. And this is actually the application of activity-based costing that the consulting do for the hospital. This is how consulting suggests hospital to charge their patients based on what activity that they charge. Even in some hospital, for each needle that you use, of course, there will be a charge for that as well, depending on. And in my case, usually when I do some injections or some kind of vaccine, there will be certain costs. They will not detail in terms of how much this is the syringe that I use, this is the tape that I use, this is cost on how much I use. We not go that far yet, but imagine that this is how they calculate and come out with the money that you have to pay for each activities in hospital. And in the principle of managerial accounting, we use information. This information is from the past that company happen. Let's say that the salary, how much you have to pay for raw material or things that part. We group them together and try to come up with a standard cost. This is basic information that we need. And we use this cost as let's say that the setup for everything. There's a in the picture there's a full purpose for that. First of all, we need information so that we can set some time incentive. If the operator in terms of factory environment, if they're doing good, we also want to reward it with the money, monetary reward for the employees. And in order to calculate how much incentive that we can give to each worker, depending on the output, depending on the throughput, we need this approach. Next, we need to control every cost that associated with the activity. This is directly the area of ABC. We want to calculate cost and benefit. This is also allocation. We want to allocate things to items of how if you let's say that if certain product produced using this machine for this much hour, this is how much this product is cost. This is how much each department have to pay for using this machine internally, of course. And lastly, we want to evaluate how much machine is used. If that economy of scale is reached, some kind of break-even point that we're gonna compute. So let me list the topic here. And also highlight what we're gonna do in this class. Of course, not gonna cover all managerial accounting. We're gonna do type of cost, of course. We're gonna do budgeting, basic budgeting. We will do break-even point, and we will do variance, but only for direct material and direct labor. This is all we're gonna do in this class. We not talk about allocation of cost yet, but remember that this is usually for the SME. This is a very big topic for SME of how we allocate things. Okay, and let me summarize this slide. This slide tells you overview about managerial accounting. It will tell you what are the topics in managerial accounting that we want to focus on. We will focus on, first of all, type of cost. We will focus on the breaking point, the break-even point. We focus on budgeting, and we focus on variance. This is 4 topics that we will focus in this class. Next, this is cost classification. As I told you, there's many ways that we can classify the cost. Some of these may be, of course, related, but here's a big one that we usually do. Without any knowledge of costing, without any knowledge of this class, each company, of course, when they think about cost, they think in terms of function, how much money that company allocate for each department. For example, R&D, how much money they have, what is the production, how much money they have, marketing, distribution. This is by function. And usually company have a certain responsibility for each functions. For example, if in terms of production, they're going to be cost center. They have to very concerned about cost. For the marketing, they may look at the revenue centers. So there's many ways that they can justify their budget. And of course, different function when of course in the marketing, they may have, let's say that the travel cost. Same with production, same with marketing. Usually this use the same standard. The way that we classify cost based on function, usually that's very obvious, very trivial. There's not get much insight in terms of how we're gonna manage costs. So this is obvious but not very useful. So something that we usually skip it, because different company, they have different function, different side of function. They want to emphasize different things. For example, if you look at very successful company, they may invest quite a lot in R&D. But if you look at the small and medium size, they will focus on production. If you look at larger size, they may focus on marketing. So the way that we look at the function is, of course, is very obvious, but not very useful. We're gonna use other metrics to classify the cost in this class. The first one that I typically use is look at element. The way that we look at element is associated with product cost. So the way that we look at product cost is this is in general by element. As an engineer, we look at how we produce each product. And of course, if you look at the tangible item like the product itself, we look at the output. Output, of course, there will be have some certain raw material as an input to manufacturing this. We require labor, and we require, of course, machine and other stuff in order to doing process, changing input or raw material into finished good. And this is the way that we look at it, is for the input itself, we look at it as direct material, DM. Next, the labor associated with process, we call it direct labor. And the rest, we call it factory overhead. This is how we look at it. I should highlight that factory overhead usually include the machine and or you can say it depreciation. Anything that happen in order to transform item into output, including of course the salary of plant managers, is also part of factory overhead. Once we get the output, imagine that this, if it's the product itself, this output is at the end of production, ready to be shipped, ready to transform to certain process, ready to go to distribution center and go to the shop. We also have another group of costs called period costs. This is have something that happened after we complete the products. We, of course, relating to the element, we also think about how we look in terms of items. The word direct and indirect will come in mind. Direct cost is mean that no matter how much you produce, this is, of course, the cost that you cannot reduce. The scale, how many items that you produce, did not affect much on direct material, on direct labor, within certain range of cost. For example, let's say that if you want to produce, this is the cost of when you want to, let's say that for the drinking water, the cost of the plastic bottle, the cost of water itself, the cost of cap and the label, this is direct material. No matter how much you produce, unless you can purchase in bulk, the direct material will, for each unit, gonna be the same. Direct labor for each unit for certain, given the certain production level, is almost the same. What you can do is that sometimes we look at indirect cost, is cost that associate with product, not directly. For example, salary. For example, like utilities, machine, because machine can produce more than one product. We look it at indirect. Basically, what I'm telling you is that sometimes we call factory overhead as indirect cost. It's not directly linked to the product, but it necessarily to transform the products. Behavior, usually direct cost is, of course, variable cost. The more you produce, the cost that doesn't change much. And the fixed cost is usually we refer to, let's say, factory overhead. And for factory overhead, sometimes we can further divide it into indirect labor, indirect material, and miscellaneous. So this is the scheme that we divide items. So this is, you can see that we have only framework. The way that you want to divide is depending on what you think, depending on imagine, depending on your effort of how much you want to dig down. And aggregate and average is the way that we control. Usually we use in terms of unit cost to control. This is how much we produce, and this is what its cost look like. And of course, we're gonna look at in terms of product cost and period cost. This also treated differently. The product cost is usually by element and is eventually transformed into inventory, or I should say finished good inventory, or cost of goods sold. And product cost is, of course, will transform into sales, general admin, and marketing. This is how things relate to income statement. So this is, of course, look in more detail of how factory operate and how it create the cost. Before we discuss further, I will, of course, require you, and this is the information that I mentioned earlier, is, of course, direct material, what it look like. Direct material in general is probably the most easiest to define. You bring the item and you look at the item, this is how much the material that need to be complete to purchase it. This is direct material. The labor is the power, the manpower that associate with how you produce. Is, of course, kind of obvious. Given certain machine, this is direct labor is kind of clear. What is not clear is factory overhead. Factory overhead is, in my experience, can range from 40 to 70% of total cost. It could be very high for the small company, because usually everything is shared in common. So for factory overhead, we usually divide it further in the indirect material, for example, carton box, pen, stationery, spare part, or indirect labor, for example, transporter, managers, and other miscellaneous things that you difficult to associate. And there's a certain term that you should aware is prime cost and conversion cost. This is prime cost is basically we group direct material and direct labor together. We look at this as this is the key cost of the items. And conversion cost is this is relating to transform item into finished good. So this is important term and definition, and I want to use this information as, let's say, the explanation of the previous slide. Next is going to be example. In order to look at how we need to look at the cost, I need to provide you with example. Example here is actually come from bottle of water. So I will have a short video to provide with this example, and what I need for you to think and perhaps answer is that what is the product cost of this item? What are the period costs and how much we should produce in general? And this is example will come as a video. I will post this video later on, but it's actually it's easier for me to link using other class. So oops. I will post this video later. It, of course, comes from YouTube, so you don't have to worry. Can you hear the video?
Welcome to Supply Chain Management. Now, I know most of you spend your childhood evening dreaming taking your first.
Can you check? Can you hear the video itself, or you cannot? Can anyone reply? Do you hear the video, or you not? Let me make sure something.
Supply chain management course. But for those Welcome to Supply Chain Management. Now, I know most of you have spent your childhood evenings dreaming of taking your first supply chain management course. But for those handful of you who might not know what supply chain management is, let me provide you a brief explanation. Let's take a simple product, like a bottle of water. Clean water, a plastic bottle, a plastic cap, and a label. Buying them at the store or vending machine might cost you about $1.50. How much of that do you think is profit? Nope. Wrong. Wrong again. Not likely. Water, a plastic bottle, and a label. That couldn't cost more than 50 cents. And if you buy them in bulk, how could each bottle not give you at least $1 in profit? Seriously. If you think you can make $1 per bottle, you should drop out of college right now and get into the bottled water business. You see, this right here illustrates one of the most common consumer misconceptions. Product cost is not equal to material cost. And in business, you don't have the luxury of thinking only as a consumer. You need to think like a business executive, or better yet, an entrepreneur. So, in order to figure out where all that profit went, we need to imagine what it took for that bottle of water to get into your hands. First, you need to negotiate the purchase of the empty bottles and caps. Those bottles will be much easier to transport if they're in boxes. We'll need to shrink wrap those bottles so they don't fall out of the box. We can move a whole lot of boxes quickly if they're all put on pallets. In order to move the pallets, you'll need a forklift, which means you'll need a forklift driver. That forklift will then take the pallet and put it into a truck, which will require a truck, driver, fuel, and insurance. Also, you'll need a label for that bottle of water. Therefore, you need to design the label, print the label, and get the label shipped to the plant. Another truck, driver, more fuel, and insurance. Our water bottling plant won't be free, and neither will the energy it uses. In our bottling plant, we'll have employees and bottling machines, and let's not forget the day-to-day items like light bulbs, garbage bags, machine parts, janitorial supplies, toilet paper, and anything else that will be used at the plant by the employees. Oh yeah, and we'll also need access to the drinking water. Machines will then purify the water. Other machines will bottle the water and affix the labels to the bottles. And still, another set of machines will box, shrink wrap, and then palletize the bottles. In order to move those pallets, again, you'll need a forklift, which means we'll need another forklift driver. That forklift will then take the pallets and put them into trucks headed to the distribution centers. And as we've seen, those trucks will require drivers, fuel, and insurance. Those distribution centers will also require employees, forklifts, and energy. From the distribution center, they'll head out to retail stores on still another truck, which will require a driver, fuel, and insurance. That store will need employees to unload the truck, stock the bottles of water on the shelf or refrigerator. If you have a refrigerator, you'll of course need energy. If we want to secure our stock, we may get a security guard or a security system. And of course, the store will likely get insurance. Also, imagine the costs associated with returning and replacing bottles that are damaged. Oh, and for some reason, even bottles of water sometimes have 1-800 numbers, which means you'll need a staffed call center to answer the customer's questions about your bottle of water. Wow! All those materials, boxes, people, machines, buildings, energy, fuel, and vehicles, they cost money. Those things weren't free, and they probably weren't used efficiently, and it's likely that several bottles didn't survive the journey to the consumer. Oh, and by the way, the employees at the water company, you know, the ones that work in finance, accounting, marketing, human resources, and IT, they want a paycheck too. So, through that simple example of a super simple product, we're beginning to see that companies face challenges when they buy things, make things, move things, sell things, and service things, which includes repair and maintenance. Oh, and let's not forget, companies need to do all these things using sustainable materials, energy, and methods. Guess whose job it is to make sure that all these things happen flawlessly, with minimal effort, and of course,
Okay.
minimal.
Let me move back. The video that you saw is actually the video that introduced supply chain management. The video serve that I showed you serving two prongs. First prong is easy. Is actually as ICE student, you have an elective on the fourth year called supply chain management. And of course, I'm not teaching that class anymore. So Dr. Arisala teach that course. If you're interested in detail, that video will serve as introduction of how you're gonna manage all the supply chain of, let's say, that the item. You will, after take that class, you probably look at how you purchase things, how they produce things differently. And for our purpose is the video is also a good source that lists how what is the item, what is the cost that company have to pay when we produce. And it's a purpose in terms of you begin to think about that sometimes some items you not perhaps you not see directly that this is the cost associated with the product itself. So, for example, the box, the pallet, the shrink wrap. This is something that we use in the factory, but as a consumer, you probably not see it. So that's something that change. And this is also a video that explain why the money in why the cost of bottle of water is so expensive because of the labor involved. And of course, there also the marketing, the expectation of how much consumer want to pay. And let go into the question. The video serve as, let's say, that the explanation of costs associated with the bottle of how we sell the bottle of water. Let's assume for the moment that we are bottling machine. We are the Coca-Cola aquifer that we want to produce a machine. We want to produce a bottle of waters, and we look at the, of course, main item, product cost and period cost. For the direct material, of course, in terms of Aquafina, we not purchase the PE. We're not gonna produce the plastic by ourselves. We're not produce the cap by ourselves. Direct material that you see is, of course, maybe bottle of water, but the plastic bottle, the cap, the label, and the water itself. And for Aquafina, it's not secret that the source of their water is tap water. That, of course, there will be a process to further purify, to remove impurity, and to bottle with water. But for the direct material, you can see that this is four main direct material. For the labor of Aquafina, the person who operate the machine, that direct labor for Aquafina. For factory overhead, anything else that you use in the factory, for example, the carton, plastic wrap, the pallet, the equipment, the maintenance crews that in the factory, the salary of the plant managers, QC inspectors, anything, the utility of the company of the factory is also factory overhead. The product cost here is everything that once is associated with to produce the item. We call it product cost, and this will be become cost of goods sold. For the period cost, anything that happened after we finish to bottle water, including transportation, including inventory, in order to sell, we call it period cost, including, of course, the salary of those who in headquarters, that's a period cost. And the question is that how much we should produce and sell. And to sell item, this question is answered quite easy. You cannot, unless your product is special, you cannot sell exceed other competitor products. Of course, and you know that the price of water is now for 400 milliliter is about 10 baht. So this is the limit at how much you have to sell. And how much you should produce is, of course, depending on the method of production. In general, for this type of factory, they produce in batch. They even produce in continuous process. So there are limits of how they produce. They have to consider another for the regulations as well. But if you break down into the cost, there's a minimum that you should produce in order to cover costs associated with everything. This is the example and how we answer it. And usually, if you do work in your professional life, or if you want to help your parent about cost of the items, I would say that every factory, majority of factories, let's say that, especially small and medium one, don't know how much their product actually costs. Seriously, this is no one know, because there's a big part, big chunk as a factory overhead that we don't know how to allocate this to which product, and depending on how allocate, the cost of product would change. So usually this is one of my student project, that you go into the factory and look at how you want to allocate item, how you want to use activity to control the cost. This is one of the possible senior project in your future if you want to do. If assume that you have a factory or have some business that require you to have a good look in terms of what is the unit cost look like, what is the association of the cost look like. Okay, I still have 30 minutes and should be able to cover this next example. Next example is actually a story from my student. He is, I say that, one of my top students who graduated master 5 years ago, and he did some thesis on the hospital, but he eventually have to take over his father factory. His factory is a paint shop. So if you think about, this is industrial type paint shop, this is how they operate. Is usually when we want to paint in terms of industrial scale, we're not gonna use the canning paint or spray paint to paint it. This is not feasible in terms of not scalable. What we usually do when we want to paint in terms of industrial scale, we want to use some kind of electromagnetic. We want to charge the item, the part, as the negative charge, and charge the paint, which is in the form of powder, as positive charge, and we blow the paint, and in order to stick with the item, and use oven, use heat to make sure that the item is stick, the paint itself is stick with the items, in order, and we do it in loop. The first stage is here is at the number one, we load the item. We hang the items along this conveyor line and go into the second station. At the second station, the item and the paint will be negatively charged and positively charged, and then we begin to blow the dust of the paint into the item. And for the second condition, you know that the paint will stick to the items. And the paint will go to, this is this. and the item will go to the oven, the heating rooms. You will see that the main cost of the painting shop is heating and paint. This is two main costs, and of course labor as well. After they go to the initial uh, heat oven, then the item will move to the fourth station. At the fourth station, we will have manual paint. There's some item that have some nook and cramp, so that unless you use manually paint it, you will see that the paint is not covered in the small area. And then the item itself is go back into the oven again in order to heat treat certain part and make sure that everything is dry, and then go out into number 6 and then unload. This is the process, and this is the you can see in the picture this is a scale that we do in to create anything that in industrial scale we use this process. We're not gonna use can paint for that, and the story is real. The question is number that you're gonna see is not gonna real. So in this case, the total cost of the paint shop is depending on number of items, number of painting item, size distribution, the surface, and what kind of paint you want to apply. Certain colors, certain metallic, especially metallic color is gonna cost you more. So, and this is the fact from this industry. Second part that you're gonna see is actually my creation. This is the information that I want to create. Let's assume for the moment that the paint is cost you $16 per gallon. And the painting machine requires certain setup time. Each setup times require $500 per setup. And if you can see the note, this is including cleaning. Cleaning is actually important part in terms of operation. You have to make sure that, let's say that all the injection of the dust is clean for all the paint. Sometimes this require you to paint some blank items in order to get rid of the previous paint as well. And using machine, it will cost you $50 per hours for the electricity and for the gas. As well as you require a technician to control the whole process. Make sure that conveyors, oven, and the paint injection, the paint spray is good. So the cost of this technician is $20 per hours to operate. On the particular days, there's an item which 4,000 pieces come into paint. This item require 10 gallons of paint, 8 hours of painting machines, and 40 carton box to packs. And the cost of carton is $40. And on average, there's an administrative utility of the paint shop is $3,600. Can you classify direct material, direct labor, and factory overhead of each piece and what it look like? This is your question. So the inspiration of this example come from the real thing, but of course number here I set up. If you look at the real detail, you will be quite messy. Everything is like in the transaction is not generalized yet, it's not grouped yet. So how you classify for DM? You will see that direct material, of course, this is the paint shop. Direct material is the paint itself is obviously direct material. And the label that technician that we use here is actually key labor that we use. You will see that in this case, not only the paint, I classify the paint as direct material. I also use carton and machine as direct material and direct labor. This is, of course, depend. Some other people may use differently. So this is how we do it in this case. I do it, let's say that in not standard way, so that you can see that in order to classify the cost, you don't have to have only single solution. So you maybe think about carton and machine as factory overhead. It's okay as well. So in this case, if we, let's say that for my assumption, I assume that paint and carton is direct material. You can see that the paint itself, we know that the each gallon is $16. The company for this piece, they use 10 gallon. So, and the carton is $40. Therefore, the total cost of painting 4,000 pieces is $200. So the cost here is 200 over 4,000, or 0.5 $0.05 per gallon, or 5 cents per gallon. $5 per piece, sorry. For the labor, I assume that the labor is, of course, there's a technician. This is cost you $20, and we use this worker for 8 hours or $160. And for the machine, this is of course like carton. I assume that we consider machine cost as direct labor. And this is, of course, in general, we typically look at the machine and carton as factory overhead. So we can calculate this. And for factory overhead, you have indirect is set up. Other, you can have admin. Usually you will have question about how we get admin costs. You know that from the question that admin is 3,600 US dollar per month. And I assume here in number 2 that we operate 30 working days. So in general is 120 US dollar per day. But you should know that in typical operations, 8 hours of operation is considered to be 1 day. So in general, the admin cost is for this product is equal to 1 day. Therefore, this is factory overhead. And if you calculate everything, you will get, this value. This is one way to do this. One way to classify the cost, and you can calculate what is the unit cost. Please remember that this is one way we do it. And another way to do it, and this is more standard, is that we consider DM is only like 160 divided by 4,000. We only consider paint only. For DL is, of course, 160 divided by 4,000. This is DL. And factory overhead is the rest, which is 40 plus. This is a more standard way that people do. So here is example that I try to do incorrect way. Not incorrect way, not popular way to calculate what is the classification of cost look like, but on the right hand side, this is how typical IE, industrial engineer, or typical management look at the cost. You will see that depending on how you want to groups, things could be different. The reason that people want to do on the right hand side is that usually it's very difficult to calculate how much carton that you use for each item. It also, of course, difficult as well to calculate how much machine for each item. This is how much we use for this product. Very difficult. So that's why we treat it as factory overhead. And I want to highlight so that, of course, this is relating to the single product, but in general, when we have to paint multiple products, and within one day, you may have to paint for many items. It number of carton that you use, number of machine hour that you use is kind of difficult. It's lost in the sum of things. So usually that the reason that we separate. Another thing that we separate is that usually we know that the carton is depend. Some customer may say that the carton that we use is not good. They want to, let's say that they have own carton. They will bring a plastic bin, for example. Or some customer, they want to be very cheap, say that you don't have to pack in carton. You can pack in the plastic or wrap it. So you can see that the cost can be different. Machine, of course, that we can mix many items together, and that's the reason that there's many ways to do cost classification. But one thing that you should aware is that here, paint and labor. Paint away direct material, and labor it away direct labors. These two things cannot change. So no matter how you want to change things, the guideline remain the same. We want to separate material that we use. We want to separate how much labor that we use, because these two things is directly relating to the cost. So this main thing is kind of difficult to argue. This is basically paint must be direct material, and technician hours, technician salary have to be direct labor. This thing cannot be changed, and the rest you can say that is the setting up. The admin is factory overhead. This is fair game as well. And for the carton and the machine, you can argue that whether how much, depending on how much you want to control, how much you want to trace, it can move to be factory overhead, or it can associate with direct material and direct labor. So the question about cost classification, of course, first thing, guideline. You have to see what is this cost, how it associates with the item. Is it very clear that to associate with the item, you should be able to trace. You should be put in either direct material or direct labor. But if it's not obvious, if you do not want to control it yet, you may move to factory overhead, assuming that it's not violate the guideline. So it kind of, in terms of calculation, is easy, but when we talk about the concept, there's a room to move. It's not like the mathematical question, not like a physics question that have only one way to do it. It's depending on how much you want to trace, how much you want to control. Do you have any question? Because in the example, it seems like obvious, right? But in the real world, you will see that there's a lot of detailed item, and sometimes it's not obvious of how you want to design, of how you want to classify. Let's see. Okay. If you don't have a question, then let me move to the next topic. After we begin to classify things of what is the product cost look like, the first application that I want to address is what we call is cost volume profit, or sometimes I maybe use my old word, break even. This is some cost analysis that we do in order to ask simple questions. How much we have to produce in order to not making profit and not incur any loss. At this level, this is analysis will tell you how much we have to produce in order to, let's say that, to stay the same, in order to justify for the fixed cost that we happen. So we use this as, let's say that as an engineer, we use this as the minimum. In order to run the machine, this is how much, this is the minimum that you have to produce. If the order is below this minimum, of course, that means that you have to maybe fill up the orders, or you maybe have to inform your superior that you're gonna run this machine at loss. Are you going to run it? Sometimes people decide to do it as well. But usually what happens is we're gonna do at the minimum order, and we will keep the extra as finished good, as inventory. We will sell it later on. So this is what this application mean. In these applications, we classify the cost into feature into two things: variable cost and fixed cost. Variable cost meaning usually it means direct material and direct labor. This is basically if you can calculate the fix for each unit. This is can be variable cost. Sometimes some people maybe use the standard unit cost as variable cost as well, but typically depending on situation, depending on application, but direct material and direct labor obviously fit in the definition of variable cost, meaning that this is a cost that you have to incur for one extra unit. It's marginal cost that happen. Fixed cost is usually the chart that regardless of how many items that you produce within certain level, or let me put it in the term that I gonna use is uh, usually we call it relevant. Sorry. Within relevant range, the fixed cost of the product remain unchanged. The reason that we want to say that within relevant range is because of the scale. Example of that is when you go to publishers, when you produce only like 10 books and 10,000 books, cost per books slightly different, greatly different. So we want to make sure that during when we do analysis, we do it within relevant range of the analysis. If you step out of relevant range, maybe it's because of we change the technology of printing rather than let's say that use a printer for only 1 to 5. You maybe use printing press, or you may use digital printing press. The volume could be affected in terms of variable cost and fixed cost. So make sure that when you do analysis, you fix on the range first. And the analysis is here. We know that the profit, in this case, we assume that for every item that we produce, we able to sell. And you require selling price and unit cost. This too is variable cost, and there's a fixed cost that associate with operating this machine. The difference between, in this case, we assume, of course, that quantity that you want to produce and quantity that you sell is equal. This is, of course, big assumption. Big assumption. We assume that we can sell it. No problem. We can sell it. There's a demand for that. And the implication of that, you will see that in some case why this analysis may not valid. And we see the difference between selling price and unit cost at what we call contribute margin. This is the profit that you will have. The profit that you have to cover the fixed cost first, and it will then spill over into the profit. The analysis is quite simple, is we assume that profit equal to 0. And then we arrange term. After we set up the profit equal to 0, you can see that quantity star, or quantity that break even equal to fixed over contribute margin. And this is the main analysis. Is we want to analyze that if we don't take any profit, not take any loss, how much item we need to produce. And key concept that we want to do is sometimes we look at contribute margin ratio or CM. This is the ratio of the profit. Sometimes in terms of company, rather than think about how much you should produce things, we use CM ratio as the priority, meaning that if the product that have very high CM, we want to produce that first, and then for the product that have low CM, we want to produce that later. But this assume that your product can be sold. So be careful when we use CM as a priority of how you rank operations. I see question, right? Oh no. Okay, there's no question. So let's say this is the concept behind the break-even point. And in the next slide, actually I have 3 examples of this analysis. I still have 5 minutes. I probably we have for time to cover the first example. The first example is very easy. It's very straightforward application of this idea. And this example, I want to show you what is the graphic information referred to. Assume that you have single products, in this case, cell phone. And you have single type of cell phone. And this cell phone is, of course, can be sold for $200 per unit. That's a cost 120 to, let's say that, purchase this cell phone from your suppliers. And the store, the shop that you have to sell this cell phone is cost you $2,000 per month. So you can think about this as fixed cost. You can think about this as selling price. And this is the cost, unit cost. Question is that as let's say that the owner of the cell phone booth, how much you have to sell, how many cell phones that you have to sell so that you are break even, so you make a profit. So I will draw 2 lines. First line is about cost. This is cost line. And next line is about profit, revenue. Oops. Okay, not exact, but you can see. This is revenue line. Revenue, of course, you know that equal to 200x. When x is number of cell phone that you are able to sell. And for the red line here, is this one is the cost, total cost, which is 120x plus 2,000. This is how much you have to, this is how much the cost you for each cell phone that you sell. And this is of course x. And this is on the y-axis, this is the price. We are looking in this area. Here, this is what we look at. This is the Q here, X here is equal to 25 units. The way we look at it is we know that the revenues must equal to the cost, and it's 200x plus 120x plus 200. Solving for x, you will get, of course, 25. What it means is, first, after calculation, you know that the break-even point is 25, meaning that you require 25 units in order to make no profit and no loss. Notice that 25 is also the location where two revenue line, the line in blues and the cost line in red intersect. So this is same information. Another information that I should aware is that for anything in red here, area here, is the where you lost money. And everything in blue here, you begin to make a profit. And at the intersection point, you not any profit or not making loss. This is break-even point, and this is how much you have to be able to sell. If you sell below 25 per month, you are in trouble. And then this is information that provide. And another thing that I should highlight is, remember that this analysis assume that number of items, number of cell phone that you sell, and number of that you produce or purchase are equal. And in general, this is not true. So minimum, you need 25 cell phone to able to make business okay. If you can sell more 25, you are in black. If you sell less than 25, you are in red. And this conclude our first day here. I would like to stop here. In next class, I will recap the concept of break-even point and maybe mention this figure, and then we will move to the example if you have more than one product, how the analysis will change. Okay, thank you for today. And if you have any question, feel free to ask